This is the worst quarter for global bonds on record in my lifetime, and I'm pretty old. So what does this mean for you? What does this mean for your clients?
Well, one of the things it means is that we're starting to see some people think about this inflation picture and this Fed hiking picture and incorporate it into their thinking. The Fed basically the market's kind of pricing in, and the Fed is saying its terminal rate is going to be 2.5%, and the 10-year jumped right up there. So I think that's one of the factors. But also what this response in the equity markets kind of says, there's a lot of people out there, and I think this is something Bloomberg has mentioned, which is that there are no alternatives to equities in some ways because the bonds look toxic, and with the inflation, cash looks toxic.
Yeah, so Tina perhaps is still the name of the game, Mark. At what level does that change, though? What level of yield would make them start to look more attractive in the bond market relative to equities?
Well, as you said at the top of this segment, there's a lot going on in the world, and I think really so much of it is out of control of the markets and in the hands of politics. And I'll just give you one example. We think that the market right now in the short term is really going to be pricing off an understanding of if we have or when will we hit the peak sanctions and oil prices. And I think that, that's a political decision because there's a survey out in Germany that 55% of the people in Germany would accept higher sanctions, even if it means supply disruption. So while you have that level of uncertainty, which could send Europe into a recession if we were to pull that supply of energy very quickly, it's hard to get a read on certain levels here before we get a little more on those kind of issues.
So with the uncertainty you speak of, Mark, how much should investors be adding to hedges here, and what should those hedges be?
Yeah, well, we still like commodities and energy-related equities here. I think, think about commodities. It's not just about the supply disruptions around Ukraine. It's also there is a drought on pretty much every continent except Australia at the moment. And, also as we come out of COVID, we do think that the demand for energy is going to remain strong and be strong through the second half of the year. And so even if we get some resolution in the tragic Ukrainian war, we still think that energy can be well supported into the second half of the year.